Introduction. Why do some traders consistently win while others blow up their accounts over and over again? It's not luck, it's not secret indicators, and it's definitely not about watching charts 24/7. The truth is, successful trading has less to do with predicting the market and more to do with understanding yourself, your system, and your psychology. Most traders lose because they treat trading like gambling. They follow the hype, they chase profits, they jump in without rules, without structure, and without a plan. But trading is not about being right all the time. It's about thinking in probabilities, managing risk, and sticking to a repeatable process. This book isn't filled with complicated jargon or unrealistic promises. Instead, it's a step-by-step guide to help you think like a professional, act with discipline, and trade with confidence. If you're tired of emotional trades, inconsistent results, and feeling lost in the chaos of the market, this book will change the way you see trading forever. Welcome to The Science of Trading, where logic meets mindset and strategy beats luck. Chapter 1. Why Most Traders Lose. Let's start with a hard truth. Most people lose money in trading. Not because the market is unfair, not because the odds are stacked against them, but because they walk into the world of trading with a mindset that's built for gambling, not for business. Ask any random person why they started trading, and you'll hear things like, "I wanted to make quick money," "I saw someone do it on YouTube," or "I thought it would be easy." These answers might seem harmless, but they reveal a deeper problem. Most traders don't actually understand what they're doing. They confuse luck with skill. They confuse wins with wisdom. And worst of all, they mistake noise for signals. Let's break this down. Imagine you're standing in front of a slot machine. You put in $1, pull the lever, and the lights flash. You win $10. You get excited. You do it again and again. For a while, it feels like you're beating the system. That's exactly how most beginners approach trading. They have no real strategy, no rules, no risk management. They're just pulling levers and hoping the market rewards them. And sometimes, at first, it does. They get a few lucky wins. Their small account turns into a slightly bigger one. Confidence kicks in. Then overconfidence. They increase their position size. They ignore their risk. They stop thinking and start feeling. Then one bad trade wipes out everything. And now they're not just confused, they're emotionally broken. The biggest mistake traders make is not technical, it's emotional. They think trading is about prediction, but it's really about reaction. It's about managing what's happening in real time, not trying to guess what will happen next. Let me say that again. Trading is not about being right. It's about being consistent. Most traders don't lose because they lack knowledge. They lose because they don't have a system. They make random decisions based on gut feelings, Reddit posts, or whatever guru is screaming loudest on YouTube. But here's the painful irony. The market doesn't care about your feelings. It doesn't reward passion. It rewards preparation, patience, and discipline. There's also a psychological trap called false confidence. It shows up after a few winning trades. Suddenly, the trader believes they've cracked the code. They start thinking, maybe I'm just naturally good at this. They stop journaling. They stop planning. They trade more often. They take more risk. And then, bang, the market humbles them. That one trade that looked perfect, it turns against them. And they don't have a stop loss because this one feels different. They hold. It drops. They add more. It drops again. They panic. Now they're stuck, emotionally attached to a trade that doesn't care about their opinion. At this point, many traders do something even worse. They revenge trade. They try to win it all back in one shot. And this is when real damage happens. Trading isn't just numbers on a screen. It's your brain versus your brain. It's the fight between logic and impulse, between plan and panic. And most people have never trained for that kind of war. In real life, we're taught to trust our instincts. In trading, those instincts can ruin you. In life, you chase rewards. In trading, chasing usually gets punished. Now let's talk about lack of a system. Imagine trying to build a house with no blueprint, no tools, and no experience, just a hammer and good vibes. Sounds insane, right? Yet that's how most people trade. They enter positions without a clear reason. They exit based on emotion. They size their trades randomly. They never review what's working or what's not. That's not trading, that's guessing. A real trader treats trading like a business. They have a plan. They track data. They manage risk like a surgeon. They know when to trade and when to sit on their hands. And most importantly, they know that losses are part of the game, not a personal failure. There's a famous quote that says, "Amateurs think about how much money they can make. Professionals think about how much they can lose." That mindset shift is everything. The best traders in the world lose money all the time, but they lose small. And when they win big. That's the game. Protect your downside. Let your upside grow. But most new traders do the opposite. They cut their winners short and let their losers run. Why? Because of fear and hope, the two most dangerous emotions in the market. They see a small profit and grab it instantly, afraid the market will take it away. Then they see a loss and hold on, hoping it will reverse. This emotional loop is what destroys accounts. There's another hidden killer: information overload. We live in a world of infinite charts, gurus, tweets, Discord signals, and proven systems. Everyone has a hot take. Everyone wants to sell you the magic formula. But the truth is, more information usually leads to more confusion. When you have too many voices in your head, you stop trusting yourself. You become reactive instead of strategic. You jump from one strategy to another, never giving any system enough time to work. This is called strategy hopping, and it's one of the fastest ways to stay stuck. One week you're a breakout trader. The next week you're scalping. Then you're trying options. Then crypto. You're always busy, but never growing. Successful traders pick a system that fits their psychology and lifestyle, and they stick to it long enough to master it. Now let's talk about the chasing problem. Chasing trades is one of the most common reasons people lose. You missed a move and now you're trying to catch it late. You see a green candle and your emotions scream, "Go, go, go." So you buy at the top right before it drops. This isn't trading. This is FOMO in action. And FOMO, fear of missing out, is like poison in your trading account. It makes you abandon logic. It makes you forget your plan. And it always ends the same way, with regret. Real traders wait. They stalk the market like hunters. They don't need to trade every day. They don't need excitement. They just want high-quality setups and a repeatable edge. So what's the solution? First, you must accept this truth. You will lose money sometimes, and that's okay. Losses are part of the game. They're tuition. What matters is how you manage them. Second, you need a trading plan. Not just a vague idea, but a written plan with clear rules for entries, exits, risk management, and review. If you can't explain your strategy to a 12-year-old, you probably don't have one. Third, you need to work on yourself as much as you work on your strategy. Because at the end of the day, your biggest enemy is not the market, it's your emotions. Let's wrap this chapter with a bit of truth. The market doesn't care about you. It doesn't care how much you need to pay your rent. It doesn't care how right you feel. The market is neutral, cold, unforgiving. But it's also fair to those who treat it with respect. If you show up with discipline, logic, and a plan, if you can manage your risk and control your emotions, if you focus on process over profit, then the market becomes a mirror. It reflects back the quality of your thinking. Most traders lose not because trading is hard, but because they never took the time to learn the science behind it. That's what this book is about. Welcome to the truth. Now let's get to work. Chapter 2. Think like a scientist. Trade like a robot. Let me ask you a simple question. When was the last time you made a trading decision based on emotion? Maybe it was that feeling of excitement when you saw a green candle shoot up on the chart, or the fear you felt when your trade went red right after entry. Or maybe it was that gut instinct telling you this one's going to be big, even though you had no data to back it up. If you've been there, welcome to the club. Every trader has felt this way at some point. But here's the truth. The longer you allow emotions to control your trading decisions, the shorter your trading career will be. To survive and succeed in the markets, you need to think like a scientist and trade like a robot. That may sound cold or even boring, but it's the truth. Great traders don't chase excitement. They chase consistency. And that starts by shifting your mindset from emotional reactions to logical systems. Let's break this idea down. In science, no one makes wild guesses and acts on feelings. Scientists start with a hypothesis, an educated assumption based on patterns or observations. Then, they test that hypothesis using data. They run experiments, they collect results. If the experiment fails, they analyze why. If it succeeds, they refine it further. There's no panic, no rush, no "I just have a feeling," just process. That's exactly how a trader should approach the market. Let's say you notice that a stock tends to bounce every time it hits a specific support level. A typical emotional trader will say, "It bounced last time, I'm buying now." But the scientific trader will say, "Interesting, let me test this. How many times did this pattern occur in the last 100 days? What was the win rate? What was the average return? What was the drawdown?" They don't trade based on one or two examples. They look for repeatable edges based on real data. This is called hypothesis-based thinking, and it's the foundation of long-term success in trading. You stop guessing, you start testing. You stop hoping, you start measuring. When you think like a scientist, you also start thinking in probabilities, not predictions. And this right here is one of the most powerful mindset shifts in trading. Most beginners are obsessed with being right. They want to predict the exact top, the exact bottom, and get that perfect trade entry. But experienced traders know it's not about being right, it's about having an edge and executing it over and over again. Let's look at professional poker players. They don't know which card will show up next, but they understand odds. If the odds are in their favor, they bet. If not, they fold. They don't win every hand, but over hundreds of hands, their edge shows up. The same applies in trading. You don't need to be right 100% of the time. You just need a system that gives you a mathematical edge and the discipline to follow it without emotion. Now let's talk about the second half of this chapter's title, Trade Like a Robot. That doesn't mean turning yourself into a soulless machine. It means trading with a level of emotional detachment that allows you to execute your system without hesitation, fear, or greed. The best traders in the world aren't emotionally attached to their trades. They don't get excited when they win or crushed when they lose. Every trade is just another step in a much bigger game. But for most traders, emotions are their worst enemy. They buy too late because of FOMO, they sell too early because of fear, they hold on to losers because of hope, and they overtrade because they want to feel something. But here's the hard truth. The more feelings you bring into trading, the more mistakes you'll make. That's why we need to think like scientists and trade like robots. Let's talk about an example. Imagine a trader named Mike. He's been trading for 6 months. He's watched dozens of YouTube videos, bought a few courses, and he's finally built a strategy based on moving averages and price action. But here's the problem. Mike still trades based on his emotions. He wakes up, checks the news, sees the market is red, and panics. He skips his setup and enters early because he's afraid to miss the move. The trade goes against him. He doesn't stop out because he feels it might turn around. It drops further. He adds to the position. Now he's sweating. His entire plan is gone. This happens again and again. Mike doesn't have a trading problem. He has a thinking problem. He's acting emotionally in a game that rewards logic. Now imagine another trader, Sarah. She's not flashy. She doesn't trade every day. She doesn't follow gurus or jump from strategy to strategy. Instead, she built one simple setup that she's tested 300 times. She knows the win rate, the average profit, the worst drawdown. She has a written trading plan. She journals every trade. She enters only when her rules are met. She doesn't care about news. She doesn't trade based on gut feelings. She takes her trade, sets her stop loss and target, and walks away. Some days she loses, some days she wins. But over time, she grows her account consistently. Sarah isn't a genius. She's just disciplined. She thinks like a scientist, she trades like a robot, and she wins. So how do you become more like Sarah? It starts by shifting your identity. Most traders see themselves as risk takers or market hunters. That's the wrong frame. You are not a gambler. You are not a fortune teller. You are a statistical decision maker operating in a game of probabilities. That means you need to remove ego from the equation. Being wrong doesn't mean you're stupid. Being right doesn't mean you're a genius. It's just data. The goal is not to be right. The goal is to be profitable over time. Let's go deeper. The best traders build systems, rules that are executed automatically without second guessing. A system isn't just an entry and exit. It includes everything: time frames, risk per trade, asset selection, trade management, and review. When you trade with a system, you eliminate most emotional noise. You're not deciding in real time whether to enter or exit. You already decided when you built your rules. This is what it means to trade like a robot. You reduce discretion. You trade what you see, not what you feel. And this doesn't mean you never adjust or improve your system. Scientists constantly refine their experiments, but they always start from a controlled process, not chaos. There's one more piece: data-driven reflection. After each week or month of trading, ask yourself, what worked? What didn't? Did I follow my system? If not, why? Track your performance like an athlete tracks their stats. No guessing, just numbers. Over time, this feedback loop makes you sharper. You start spotting your own patterns. You learn which setups work best for you. You discover where your emotions sabotage your process. And eventually, trading becomes less about feelings and more about execution. Let me share a personal story from a trader I once coached. He used to trade based on Twitter alerts and breaking news. Every day was a roller coaster. He made money fast, he lost it faster. His confidence was tied to his profit and loss. Then one day, he lost $15,000 in a single afternoon because he went all in on a stock that couldn't fail. That loss broke him, but it also woke him up. He stepped away. He took 6 weeks to build a real system. He back-tested everything. He started trading one setup with one asset with fixed risk. It was boring, but boring made him profitable. Now, he's a full-time trader because he stopped trading like a gambler and started trading like a machine. Let's end this chapter with something powerful. Emotional trading feels good in the moment, but hurts long-term. Systematic trading feels boring in the moment, but wins long-term. If you want real results, if you want consistency, if you want to survive in this game, you have to take your emotions out of the equation. Trade like a robot, think like a scientist. Follow the process, refine the process, trust the data. That's how you build real success. Chapter 3. The Edge Equation. Let's clear something up right now. You don't need to win every trade to become a profitable trader. In fact, you could be wrong more than half the time and still make a fortune. Sounds crazy, right? But that's the beauty of understanding your trading edge. Your edge is not a magic setup. It's not the perfect indicator. It's not some holy grail strategy that always wins. Your edge is a math equation, a simple but powerful formula that separates consistent winners from emotional gamblers. The problem is, most traders have no idea what their edge even is. They just take trades, hope for the best, and feel confused when they win some and lose more. But once you truly understand the edge equation, everything changes. It becomes your compass in the chaos, a filter for every trade, a measuring stick for every system. Let's break it down. At the core of your edge is one word: expectancy. Expectancy is a formula that tells you over the long run how much you can expect to make or lose per trade, assuming you follow your strategy consistently. Here's the simple version of the expectancy formula. Win rate times average win minus loss rate times average loss equals expectancy. Let's say you win 50% of your trades. When you win, you make $200. When you lose $100. Plug that into the formula. 0.5 times 200 minus 0.5 times 100 equals $100 minus $50 equals $50 expectancy. This means that every time you place a trade, you expect to make $50 on average. Even if your win rate is just 50%, the edge is positive because your average win is bigger than your average loss. Now here's the shocking truth. Most traders never calculate this. They're obsessed with being right, chasing high win rates and avoiding losses altogether. But that mindset is dangerous. A high win rate doesn't always mean you're profitable, and a low win rate doesn't mean you're failing. It's not about how often you win, it's about how much you win when you win and how much you lose when you lose. That's the real game. Let me tell you a story. I once worked with a trader named Kevin. He had a system that won 80% of the time. Sounds amazing, right? But there was a catch. When he won, he made $100. But when he lost $800. His win rate looked beautiful, but his losses were killing his account. One bad trade would erase the gains of 8 winning trades. And eventually, a few bad trades in a row wiped out months of progress. On the flip side, another trader I knew, Lisa, had a system that only won 40% of the time. But when she won, she made $500. When she lost only $100. So her edge was massive. Over time, she became one of the most consistent traders I've seen, not because she won often, but because she managed her risk and let her winners run. This is why understanding your risk-to-reward ratio is so crucial. The risk-to-reward ratio, often written as RR, is simply how much you're risking compared to how much you're trying to make. If you risk $100 to make $300, your RR is 1 to 3. The higher your RR, the more room you have for error. If your RR is 1 to 2, you only need to be right about 34% of the time to break even. Think about that. You can lose more than half your trades and still walk away profitable. But most traders flip the ratio. They risk $300 to make $100. They scalp for small profits and take huge losses. They don't cut their losers, but they cut their winners. That's not trading. That's bleeding slowly. Winning traders built strategies around asymmetric returns, meaning the upside is bigger than the downside. They understand that the goal is not to win every trade. The goal is to win bigger than they lose, and to do it consistently over time. Now let's talk about position sizing. This is where the edge either becomes powerful or becomes poison.
Even if you have a positive expectancy strategy, if your position size is too big, you will eventually blow up your account. Because one losing streak, one emotional trade, one mistake, and boom, the damage is done. Most traders size their positions based on how confident they feel. But confidence is not a strategy. Data is. The best traders risk a fixed percentage of their account per trade, usually 1% or less. This sounds small, but over time, this allows you to stay in the game long enough for your edge to play out. Think about a casino. They don't win every bet, but they know the math is in their favor. So they let the odds work over hundreds and thousands of plays, and they never bet so much on one roll that it could put them out of business. You should think the same way. Your goal is not to get rich quick. Your goal is to compound consistently. Small controlled risk, large occasional wins, steady growth. That's how professional traders think. Let's go back to expectancy again. If your strategy has a positive expectancy, even a small one, and you apply it over hundreds of trades with proper risk management, you can grow your account with stability and confidence. But if you don't know your expectancy, you're flying blind. Every trade feels random. You win, you feel good. You lose, you feel bad. But you never know if your system is actually working because you never did the math. Most traders skip this step because it feels boring. They'd rather chase indicators or watch another video about this one strategy banks don't want you to know. But this is the step that separates pros from amateurs. Professionals know their numbers. They know their average win. They know their average loss. They know their win rate. They know their expectancy. And because of that, they don't panic after a losing streak because they trust their edge. They've seen it work over 100+ trades. They've tested it. They've tracked it. They've lived it. There's another myth that hurts a lot of traders. The myth of consistency. Traders believe that once they find the right system, every week will be green. That's not how trading works. Even with a strong edge, there will be losing streaks. Some weeks will suck. Some months will test your patience. But over time, the edge shows up. It's like flipping a slightly rigged coin. Maybe it lands heads 55% of the time. In the short term, you might get a few tails in a row. But flip it 1,000 times, and the 55% edge becomes very real. This is why emotional traders quit too early. They test a system for 5 trades, hit 3 losers, and say, this doesn't work. But 5 trades mean nothing. Would you judge a casino based on 5 bets? Would you judge a baseball player based on 1 game? No. You need a large sample size to let the math work. That's what most traders never give themselves, the chance to let their edge play out. Let's bring all this together. If you want to become a consistently profitable trader, you need 3 things. First, a strategy with a positive expectancy where the combination of win rate and risk to reward gives you a mathematical edge. Second, position sizing that protects your tactical and allows you to survive losing streaks. Third, the discipline to execute that strategy over and over without emotional interference. This is the real edge equation. It's not exciting, it's not sexy, it won't get clicks on YouTube, but it works. And it's the difference between those who treat trading like a business and those who treat it like a hobby. I want to leave you with something that could change your trading forever. Your edge is not just your strategy. Your edge is how you manage your trades, how you manage your risk, and how you manage yourself. Most traders are looking for the perfect entry. But the truth is, you can give a mediocre entry to a disciplined trader with a great edge, and they'll make money. And you can give the perfect entry to an emotional trader with no plan, and they'll still lose. That's how powerful this stuff is. Don't just chase trades, chase edge. Don't just chase results, chase process. Know your numbers, trust your math, let the edge play out. Because in the end, the market doesn't care about your hopes or opinions. It only rewards discipline, patience, and probability.
Chapter 4. The Psychology Trap. If trading were just about charts, indicators, and systems, most traders would be rich. But they're not. And the reason isn't a lack of strategy. It's not bad market conditions. It's not some hidden trick that only the pros know. The real reason: psychology. Your mind is the battlefield, and unless you learn to control it, the market will expose every weakness you have and punish you for it. Trading doesn't just test your skills. It tests your patience, your discipline, your emotional control, your ability to lose gracefully, and your willingness to follow rules when your instincts scream the opposite. This is the psychology trap. And if you're not aware of it, it will pull you in every time. Let's start with the most common enemies: fear and greed. These two emotions are deeply wired into your brain. They kept your ancestors alive when they were hunting for food or running from predators. But in the trading world, those same instincts will destroy your account. Fear shows up in many ways. Sometimes it's fear of missing out, FOMO, the urge to jump into a trade because everyone else is making money. You see a green candle exploding upward and your mind says, "Get in now, don't miss it." Other times, it's fear of losing money. You cut your winners short because you're afraid the profit will disappear. Or you refuse to take a loss, hoping the market will bounce back, and it keeps falling. Then there's greed, the voice that tells you, "Let it ride just a little longer." You're in profit, but you get greedy. You ignore your exit plan. You want more. You overstay the move. Greed also makes you increase your position size way too early. You double down on a setup you barely tested because the last one worked. You feel lucky. You feel invincible. And that's exactly when the market humbles you. The problem with both fear and greed is that they disconnect you from your system. They override your logic. You stop thinking and start reacting. And in trading, reaction without structure is chaos. Every trader goes through this. They start the day calm and rational, they swear they'll follow their plan, but once the trade is live, once real money is moving, it's like their brain flips. Now it's not just a chart, it's their money on the line. Their emotions take over. They stare at the screen, they can't breathe, they click too fast, they change their mind mid-trade, they feel out of control. This emotional roller coaster isn't a sign that you're weak. It's a sign that you're human. But if you want to win in this game, you can't trade like a normal human. You need to trade like a professional, someone who has trained their mind to stick to the system no matter what. You need to become emotionally self-aware. Let's talk about FOMO a bit more, because it's one of the most dangerous traps out there, and almost every trader falls into it at some point. FOMO doesn't just make you enter trades too late, it makes you abandon everything you've worked on, your logic, your edge, your system, just because you're afraid of being left behind. It's that panic that everyone else is winning and you are not, that if you don't get in now, you'll miss the big move. And that panic clouds your thinking. You enter a trade with zero preparation, no stop loss, no clear exit, just the feeling that this one's gonna go. And sure, maybe it does go, but most of the time, it doesn't. You're late to the move. You're buying high. You're the exit liquidity for someone else's sell. And when the trade turns against you, you feel shame. You feel regret. You promise yourself not to do it again until the next setup triggers the same emotional reaction. This is the loop. This is the trap. FOMO isn't about the market. It's about your relationship with uncertainty. Your brain wants certainty. It wants to believe it's missing out on something real, and the market plays with that desire like a puppet master. The only way out
is awareness. Start asking yourself questions before every trade. Am I taking this trade because it fits my plan or because I'm afraid of missing something? Would I take this same setup if I wasn't watching other people trade? Do I know my risk before I enter, or am I winging it? These questions bring you back to your prefrontal cortex, the part of your brain that makes logical decisions. You pull yourself out of fight-or-flight mode and back into a state of control. The more often you do this, the more you train your mind to respond instead of react. Now let's talk about another silent killer: overtrading. Overtrading happens when you feel like you must trade. It's rooted in boredom, impulse, and often the desire to make back what you just lost. You take setups that don't really meet your criteria. You trade out of habit, not conviction, and you exhaust your mental energy chasing small moves that offer little reward. Eventually, you burn out. Your focus fades, your discipline weakens, you start revenge trading, taking bigger risks to recover losses. And that's when your account takes a serious hit. The best traders don't trade more, they trade better. They know when to sit out, they know when to walk away. They understand that not trading is also a trade, a decision to preserve capital, protect mental energy, and wait for high-quality opportunities. Sometimes, the most powerful action you can take as a trader is to do nothing. Now let's go even deeper, into cognitive distortions. These are false patterns of thinking that sneak into your brain and distort how you see the market. And most traders have no idea they're even happening. One common distortion is confirmation bias, the tendency to seek out information that confirms what you already believe. You enter a trade, and now everything you see seems to support your position. You ignore warning signs, you dismiss red flags, you become blind to the risk. Another distortion is loss aversion, the idea that losses hurt twice as much as gains feel good. This causes you to hold on to losing trades way too long and cut winners way too fast. Then there's gambler's fallacy, the belief that if you've had 5 losing trades in a row, the next one must be a winner. But the market doesn't care about your streak. Every trade is independent. The market has no memory. These distortions are mental traps. They feel true, but they're not based on logic or evidence. The only way to escape them is to build awareness and track your thoughts just like you track your trades. Start journaling your emotions. Write down how you felt before, during, and after each trade. Over time, you'll notice patterns. You'll see how fear creeps in when you size up. You'll see how greed shows up when you're on a winning streak. You'll learn how your brain tries to trick you. And once you recognize these patterns, you can begin to reprogram your behavior. This isn't about becoming a robot. It's about becoming a master of your own mind. Let's be honest, the market doesn't care how smart you are. It doesn't care how much you studied. It doesn't care about your dreams or your desperation. It only rewards one thing: consistency. And consistency starts with emotional control. If you let your emotions dictate your actions, you'll always be chasing the market. But if you learn to observe your emotions without obeying them, you take back your power. You become the calm in the storm. You become the one who follows the plan even when it's hard, especially when it's hard. And that's when you start to separate yourself from the crowd. There's a famous quote by Mark Douglas, author of Trading in the Zone. He said, "Trading is 80% psychology and 20% methodology." That's not an exaggeration. That's a fact. You could have the best system in the world, one that works 70% of the time, but if you don't have the psychological strength to follow it through drawdowns, through boredom, through stress, you'll still fail. Your emotions will find a way to sabotage you. But once you learn how to see your emotions for what they are, just signals, not instructions, you become unstoppable. Let's make this practical. The next time you feel fear during a trade, pause. Ask yourself, what am I really afraid of right now? Is it losing money? Is it being wrong? Is it disappointing yourself? Once you name the fear, you strip it of its power. Now you can face it with logic. Remind yourself, losses are part of the game. One trade doesn't define your future. One bad day doesn't erase your edge. This is how pros think. They don't ignore emotions, they acknowledge them, and then stick to the plan anyway. That's the skill you're building here. Every time you follow your rules when it would have been easier to react emotionally, you train your brain, you strengthen your trading muscle. And the stronger it gets, the more consistent you become. You don't need to be fearless. You need to be disciplined in the presence of fear. You don't need to kill greed. You need to recognize it and act against it. You don't need to fight your emotions. You need to lead them. And that's the truth most traders never hear. They think the answer is more indicators, more signals, more news.
Chapter 5. Data doesn't lie. You do. If there's one thing the market respects, it's truth. Not opinions, not emotions, not hope. Just the cold, hard truth. And in trading, that truth lives in your data. Here's the uncomfortable reality. Most traders are lying to themselves. Not intentionally, but through ignorance, ego, or avoidance. They tell themselves their strategy is working when it's not. They believe they're consistent when they're not. They convince themselves they're improving, yet have no proof to show it. This is why most traders stay stuck. Because they're flying blind. They're guessing, hoping, assuming, reacting, but they're not tracking. They have no journal, no logs, no system for reviewing their performance. They're playing a data-driven game with emotion-driven behavior, and they wonder why it doesn't work. But once you start tracking, everything changes. It's like turning on the lights in a dark room. Suddenly, you can see what's working and what's not. You can stop relying on memory and start relying on evidence. And that's when growth becomes real. Let's start with one of the most important tools you'll ever use. Your trading journal. I'm not talking about a notebook where you scribble, "Buy Apple at $185" and move on. I'm talking about a structured, detailed, honest record of every trade you take, why you took it, how you felt, what setup it followed, what time of day it was, how much you risked, how much you made or lost, and what the result was. This might sound like overkill, but it's not. It's essential. Because you can't improve what you don't measure. Your trading journal is not just a record of your trades, it's a mirror of your behavior. It reveals your patterns. It exposes your weaknesses. It shows you exactly where you sabotage yourself and where your edge truly lies. Let's say you start journaling and after 50 trades, you notice something. Most of your losing trades happen when you enter before 10 a.m. Or that your setups work better on trending days than choppy ones. Or that every time you size up emotionally, you lose more than usual. You'd never notice these patterns without data, but once you see them, you can adapt. You can optimize. You can stop doing what hurts you and double down on what helps you. That's the power of journaling. And here's the truth. Most traders avoid this process because it holds them accountable. It's easy to lie to yourself when there's no record. It's easy to say, that setup just didn't work, instead of facing the fact that you broke your rules. It's easy to believe you're profitable, until you realize your win rate is actually 42% and your losses are twice as large as your wins. But data doesn't care about your feelings. It just tells the truth. That's why so many traders avoid looking at it, because the truth stings. But here's the flip side. Once you embrace the truth, you gain power. You're no longer guessing. You're evolving. You're upgrading from emotional amateur to data-backed professional. Now let's go one step further. Backtesting. Backtesting is the process of testing your strategy on historical data. You take your rules and apply them to past market conditions to see how they would have performed. This is not a guarantee of future results. Nothing in trading is, but it gives you a statistical foundation. It gives you confidence that your system has worked in different conditions, not just the last 2 days. Without backtesting, your strategy is just a theory. You might feel like it works, but you don't actually know. Backtesting gives you the numbers. You find out your win rate, your average risk to reward, your maximum drawdown, your average holding time, and more. You find out how your system performs on trend days, range days, and news events. You find its strengths and weaknesses. This is where most strategies die, because when you test them honestly, you realize they only worked in one very specific condition, or they were fueled by luck, not logic. But that's good. Better to find out now than after blowing a live account. Think about professional athletes. They watch tape. They review performance. They track stats obsessively. They don't rely on vibes. They rely on analysis. You need to do the same. If your trading system is your weapon, backtesting is the sharpening process. It turns your system from a guess into a tool. Now let's talk about the most painful but necessary part of this process. Performance review. Once you've journaled your trades and tested your system, you must step back regularly and ask the big questions. Am I following my system or breaking my rules? Is my edge still working in current market conditions? What's causing my biggest losses? The market or me? Which setups are making me the most money? Which ones are bleeding me? How is my risk to reward evolving? Am I improving my execution? These questions might seem obvious, but most traders never ask them. They just keep trading blindly, hoping it'll get better. But trading doesn't reward hope. It rewards adaptation. If you review your trades weekly or monthly, you'll see patterns that others miss. You'll notice small leaks in your system before they become gaping holes. You'll realize that your worst enemy isn't the market. It's your inconsistency. And here's the most powerful realization of all. Your data becomes your coach. It tells you when to push, when to pause, and when to pivot. When you treat your data like feedback, not failure, you start to grow at a speed that surprises you. You stop being a trader with potential and start becoming a trader with results. Now let's address a common excuse. I don't have time to journal and track everything. Let me be blunt. If you don't have time to track your trades, you don't have time to be a trader. Because trading isn't just pressing buttons. It's a business, and every real business has accounting, review, and performance analysis. Imagine running a restaurant but never checking your inventory, never reviewing customer feedback, never tracking profits or losses. That restaurant would go under in weeks. It's the same with trading. You are the CEO of your trading business. If you're not reviewing the numbers, no one else will. Now, here's the good news. You don't need to be perfect. You don't need a 12-tab spreadsheet or a $500 software subscription. You just need to start. Start with a simple Excel sheet or a Google Sheet. Columns for date, ticker, entry, exit, reason for entry, result, notes. That's it. Then, each week, go back and look at the data. Find the patterns. Ask the questions. Be honest. Over time, you'll refine it. You'll build dashboards. You'll track more metrics. But the point is, start now. Don't wait until you've figured it out. This is how you figure it out. There's another reason data matters that's rarely talked about. It protects your confidence. Trading is an emotional game.
You will go through losing streaks. You will have days where everything feels broken, and if you don't have data to remind you that your system works, you'll start to doubt yourself. You'll abandon good strategies. You'll chase shiny objects. You'll fall into desperation. But when you have months of data showing your system's edge, you'll stay grounded. You'll know that the drawdown is temporary because you've seen how the numbers play out over time. Data gives you perspective. It helps you zoom out. One bad day doesn't mean your edge is gone. One loss doesn't mean you failed. It's just one point on a much larger curve. And this perspective is priceless. Let's bring this home with one final truth. Data doesn't lie, but you do. You lie when you say you're consistent, but can't prove it. You lie when you say your strategy works, but you haven't tested it. You lie when you say you're improving, but there's no evidence of growth. None of this makes you a bad trader. It makes you a normal human. We all lie to protect our ego. We want to feel like we're doing well. We want to avoid the discomfort of hard truth. But trading punishes ego. It rewards honesty. So if you're serious about this game, start treating your data like gold. Because it is. It's your compass, your teacher, your truth. Every trade you log, every metric you track, every lesson you extract, it all compounds into skill, into discipline, into long-term edge. And when the time comes to scale up, when your account is larger and the stakes are higher, your data becomes your greatest asset. Because you're not just trading setups anymore. You're trading with confidence, clarity, and control, built on a foundation of truth. That's how pros operate. That's how you rise. And it starts now.
Chapter 6. The Power of Process over Outcome. If there's one idea that separates elite traders from average ones, it's this. Successful traders don't obsess over outcomes, they obsess over process. In the world of trading, results are noisy. One good trade can make you feel like a genius. One bad trade can make you question everything. But neither of those feelings actually tells you the truth about your skill. That's the trap most traders fall into. They judge themselves based on profit and loss. If they made money today, it was a good day. If they lost, it was a bad one. But here's the truth that takes years for most people to learn. A good trade can lose money, and a bad trade can make money. This sounds backward at first, but it's the heart of professional thinking. You can follow your rules perfectly, take a setup with edge, size it right, manage it calmly, and still lose money. That's just how probability works. No edge wins every time. Losses are part of the game. And on the flip side, you can take a terrible trade, one with no setup, no stop, all emotion, and still get lucky and make money. But that win doesn't make it a good trade. It makes it a dangerous one. When traders focus only on the result, they become emotionally fragile. They feel amazing when they win and worthless when they lose. They change their strategy after a few red days. They chase performance. They revenge trade. They trade based on fear, not structure. And eventually, they blow up, mentally, emotionally, and financially. But when traders focus on process, everything changes. The process is what you can control. The outcome is not. You can't control what the market will do next. You can't control whether a trade will be green or red. But you can control how you plan your trades, how you size them, how you manage your risk, how you follow your rules, how you review your performance. That's the process, and over time, it's the process that creates results. Think of it like fitness. If someone's goal is to lose 10 pounds in 2 weeks, they'll probably crash diet, skip meals, and do something unsustainable. They might lose the weight, but it won't last. They'll burn out and gain it back. But if someone focuses on eat healthy meals 5 days a week and work out 4 times, the results will come slowly, sustainably, and permanently. Trading is the same. Process goals build discipline. Outcome goals build anxiety. When you focus on the outcome, you rush, you force trades, you get frustrated when the market doesn't cooperate. But when you focus on the process, you zoom out. You play the long game. You become steady, consistent, grounded. So what does focusing on the process actually look like? It starts with defining your daily trading process, not your daily profit goal. Most new traders say things like, "I want to make $500 a day." But that goal leads to impulsive behavior. You start the day already attached to a number, and if you're not close to hitting it by lunch, you panic, you force trades, you violate your rules, you turn a manageable loss into a blow-up. But here's the truth of process-based goals. It sounds like this. I will take only A-plus setups today. I will risk 1% per trade. I will follow my trading plan exactly. I will journal every trade and review it at the end of the day. Those goals have nothing to do with money and everything to do with behavior, which is the part that actually creates results in the long term. Here's the paradox. When you stop chasing profits and start executing with discipline, that's when the profits come. Because you're not acting out of fear anymore. You're not chasing. You're not panicking. You're following a structure. You're letting your edge play out. And that's what trading really is. A numbers game played with emotional control. Let's talk about how the brain reacts to outcome-based thinking. When you get a win, your brain gets a dopamine hit. It feels good, so it wants more. That leads to overtrading. You want to repeat that feeling. But if the next trade is a loss, that hit disappears. You feel disappointment. You get anxious. You start trying to make the loss back, and the cycle begins. This is how traders become addicted to the emotional highs and lows of the market. But when you focus on the process, the emotional volatility drops. You don't celebrate every win or mourn every loss. You measure success by how well you followed your system, not by how much money you made. You start to see your job as a professional executor, not a profit chaser. And this shift in identity is everything. You go from being a gambler to being a builder. You build consistency. You build habits. You build systems. And in the long run, that's what builds success. The truth is, every profession that deals with risk, sports, investing, military strategy, understands this. Professionals train for the process. They rehearse the steps. They trust the plan. They know that if they execute the right way consistently, the results will follow. But amateurs want instant gratification. They want results now. And when they don't get them, they quit. This is why most traders never make it past the first year. They're obsessed with results. They ignore the process, and they burn out. Let me give you a real example. I once coached a trader named Jacob. He had been trading for 3 years and was stuck in a loop. Some months were green, others red. He'd make a lot, then lose it all. No consistency. When we looked at his system, it was solid. The setups had edge, the strategy made sense, but when we dug into his journal, what little he had, I noticed something else. He was changing his system constantly. After 3 losing trades, he'd change something. After a big win, he'd size up. After a losing week, he'd take 2 weeks off and come back with a new approach. He wasn't giving his process time to work. When we switched his focus from profit goals to process goals, everything changed. He started tracking every trade with brutal honesty. He reviewed his performance every weekend. He set goals like, I will follow my stop-loss rules for every trade this week, or I will take only 3 trades per day max. Within 3 months, he didn't just have a more consistent P&L, he had a more peaceful mindset. The pressure was gone, the anxiety faded, the revenge trading stopped. Because he was no longer trying to win every day, he was trying to execute well every day. And that made him a winner. This chapter isn't about ignoring results. Results matter. They're how we get paid. But they're not how you grow. You grow by refining your process, improving your edge, tracking your behavior, reviewing your trades,
protecting your capital, and repeating the small habits that build long-term success. This mind shift doesn't just help you trade better, it helps you survive the rough patches. Because every trader hits slumps, everyone goes through drawdowns. But if you're focused only on outcomes, those drawdowns feel like failure. You doubt yourself, you spiral, you quit. But if you're focused on the process, those same drawdowns become data. They're just feedback. They show you where to improve. They teach you patience. They harden your discipline. And you keep going. Because you know that consistency wins. You know that small wins repeated over time beat big wins that can't be repeated. You know that showing up day after day, sticking to your plan, doing the boring but essential work, that's what creates greatness. Not one big trade, not one lucky week, but one solid execution at a time. So here's what I want you to ask yourself every day from now on. Did I follow my plan? Did I take only the trades I said I would? Did I manage my risk? Did I journal honestly? Did I review my performance? If the answer is yes, then you won today, even if your P&L says otherwise, because you built the habits that lead to real success. This is how you shift your identity from outcome chaser to process master. And once you make that shift, trading stops feeling chaotic. It starts feeling calm, focused, structured. You no longer need to chase profits because you've built the machine that creates them. One rule at a time, one habit at a time, one process at a time.
Chapter 7. Build your personal trading system. There comes a point in every trader's journey when they realize that copying someone else will only take them so far. You might start by mimicking someone's entries, using the same indicators or following alerts from Twitter or Discord. That's fine in the beginning, but eventually, if you want to trade consistently, you need to stop following and start building. That's where your personal trading system comes in. A trading system isn't just a set of rules, it's your framework for decision-making, your blueprint for action, your way of making sense of chaos. It removes emotion, enforces discipline, and creates consistency. Without it, you're reacting to the market. With it, you're following a plan. Think of your trading system like your GPS. If you try to drive across the country without one, you'll probably get lost. But with a clear route, even if there are bumps or detours, you'll still reach your destination. Building a personal trading system is not about making it perfect. It's about making it yours, based on your personality, lifestyle, capital, risk tolerance, and preferences. What works for a scalper who loves fast-paced trades on a one-minute chart may be a nightmare for someone who has a full-time job and checks the market only after work. Your system needs to match you, or it will break under pressure. Let's start with the first core component, your entry criteria. This is where most traders either get too loose or too rigid. A solid system has clear entry rules, but those rules must be based on repeatable market behavior. Maybe you trade breakouts, or pullbacks, or trend reversals. That's fine, but what defines the setup? What signals must align? If you can't describe your entry with objective conditions, it's not a system, it's a feeling, and feelings don't scale. Let's say your strategy is buying a pullback in an uptrend. You might define that as the 20 EMA is above the 50 EMA, price pulls back to a demand zone, and there's a bullish engulfing candle to confirm the reversal. That's an entry rule. It's testable. It's repeatable. It removes doubt. Without rules, your emotions take over. You'll talk yourself into random trades. You'll chase moves that don't meet your criteria. You'll second-guess your judgment. But with clear entry conditions, you eliminate that uncertainty. Next comes your exit strategy, arguably even more important than your entry. Most traders spend hours trying to time the perfect entry and almost no time thinking about how or when they'll exit. But your exit is where you get paid. It's what determines your risk-reward.
It's what protects your capital. You need two things here: a stop-loss strategy and a take-profit strategy. The stop-loss protects the downside. The take-profit locks in the upside. And both should be defined before you enter a trade. Maybe your stop-loss is based on technical structure, below the last swing low, below a moving average, below a support level. Whatever it is, it must be consistent. Same with profit targets. Are you aiming for 1 to 2 risk-reward, or are you trailing your stop as price moves in your favor? Are you scaling out at key levels? These decisions should not be made while the trade is live. That's when emotions are highest. Your job is to act like a robot during execution. Just follow the plan. Now let's talk about time frame alignment. This is where a lot of traders get confused. They see a bullish pattern on the 1-hour chart, but a bearish trend on the daily, and they're stuck. Do they go long or short? This is why multiple time frame analysis matters. You want your system to align your higher time frame context with your lower time frame execution. For example, your daily chart might show the trend. The 4-hour chart might show key support and resistance zones. The 1-hour chart might show your actual trade setup. All three should be pointing in the same direction, or at least not contradicting each other. If your system defines the daily trend as bullish, but you're looking for shorts on the 15-minute chart, you're fighting the market. And most of the time, the market wins. A solid system has frame agreement. It knows where it's playing and why. Now we come to the heart of it all: risk per trade. This is what separates gamblers from pros. Risk management is not optional. It's the core of survival. You must define, in your system, exactly how much you're willing to risk per trade. For most professional traders, it's between 0.5% and 2% of total capital. That means if your account is $10,000, your risk on a single trade should be $50 to $200, depending on your comfort and strategy. This isn't just about math. It's about emotional control. Because when your risk is defined, you stop fearing losses. You know the worst-case scenario, and you can take multiple losses in a row without blowing up. This lets your edge play out. Remember, you can have a 40% win rate and still be wildly profitable if your winners are twice the size of your losers. But that only works if your losses are contained. Your system must protect you from yourself. Now let's get a bit more advanced: automation and checklists. Even if you don't use automated bots, your system should feel automated in your brain. It should run on rules, not moods. One of the best tools here is a trading checklist. Before every trade, you go down the list. Is the market in the right condition? Is the setup valid? Are all my criteria met? Is my risk defined? Am I trading out of confidence or boredom? This checklist becomes your filter. It slows you down. It forces you to be deliberate. It stops you from taking impulsive, revenge-fueled trades. When you follow it religiously, you trade less, but you trade better. That's how consistency is born. Here's the thing: building your system takes time. You won't get it right the first time. You'll make mistakes. You'll tweak rules. You'll refine your entries, exits, and risk models. That's part of the process. In fact, iteration is the real edge. The best traders don't have magic strategies. They have systems that evolve. They track performance. They spot weaknesses. They test ideas. They stay curious, and they adjust based on data, not feelings. You must do the same. The system you build today will not be the same system you trade a year from now. But that's the goal: progress, not perfection. Let me share a personal story. I once worked with a trader named Chloe. She was sharp, analytical, and disciplined, but she kept bouncing between systems. One month she was trading breakouts, next month reversals. The month after that, she was scalping news events. She wasn't giving any approach the time it needed to develop. She wasn't gathering real data. She was starting over every time she hit a drawdown. When we sat down and built her a simple, rule-based system focused on trend pullbacks on the 4-hour chart, everything changed. We defined her entry rules, stop-loss placement, risk per trade, and target structure. We created a checklist. And most importantly, she committed to trading only that system for 3 months. At first, it was tough. She wanted to deviate. She got tempted by other setups, but she stuck with it. And for the first time, she started seeing real consistency. Not because the strategy was perfect, but because it was hers. She knew it inside and out. She trusted it. And that trust gave her confidence to execute without hesitation. That's what you're building here. Not just a system, but trust. Trust in your rules. Trust in your process. Trust in yourself. And here's the kicker. The market will still test you. You'll have losing streaks. Your system will have drawdowns. You'll question everything. But if you've built your system with intention, backed by logic, tested with data, aligned with your personality, you'll stay grounded. You won't jump ship at the first storm. You'll ride it out. Because systems don't win or lose in a single trade. They win or lose over hundreds of trades. That's the mindset of a professional. You're not here to predict. You're here to execute. You're not here to win every day. You're here to follow your system every day. You're not here to be perfect. You're here to be consistent. And that consistency is what separates those who survive from those who fade away. So if you take one thing from this chapter, let it be this. Build the system that fits you, not someone else. Because trading success doesn't come from finding the Holy Grail. It comes from finding your groove and staying in it day after day, trade after trade, win or lose.
Chapter 8. Mastery Through Boredom. When you hear stories about successful traders, you might imagine fast-paced action, high adrenaline, and dramatic wins. Hollywood loves to portray trading as a thrilling roller coaster, constant excitement, big gambles, and instant riches. But the reality is almost the exact opposite. Elite traders aren't chasing excitement. In fact, they're often bored. And that boredom isn't a weakness, it's the secret ingredient to lasting success. This chapter is about why boredom is not just normal for professional traders, but essential. It's about how patience, repetition, discipline, and routine build mastery. And it's about why the quiet, steady work of trading every day is the real secret to long-term profits. Let's start with patience. If you want to be a great trader, you have to learn to wait. And not just wait, but to wait without anxiety, frustration, or FOMO, fear of missing out. Most new traders don't understand this. They want to trade every setup, every tick, every move. They think that the more they trade, the more they'll make. But the market doesn't work that way. Quality beats quantity. Sometimes the best trade is no trade at all. Patience is about waiting for your edge to show up clearly, waiting for all your system's criteria to align perfectly, waiting for confirmation instead of jumping early, waiting for the right market conditions. This kind of patience feels boring because it means sitting on your hands, watching the charts, and doing nothing. But that nothing is actually where the magic happens. It's where you conserve your capital, protect your psychology, and prepare for the right opportunity. Patience is the guardrail that keeps you from wrecking your account, and it's also a mindset. When you accept that trading isn't about constant action but selective action, your mindset shifts. You stop chasing, you stop forcing, you start respecting the market's pace. Next comes repetition. Mastery in any field comes from doing the same thing over and over, the same drills, the same routines, the same rules. If you think trading is about discovering the next secret indicator or strategy, you're missing the point. The real power lies in repeating your edge consistently. This means taking the same setups, managing risk the same way, following the same routine every day. Repetition feels boring because it's not flashy, it's not exciting, but repetition creates muscle memory,
It builds instinct. It makes you fast and confident. Think about a professional athlete. They don't show up to the game and wing it. They spend thousands of hours practicing the fundamentals until they become automatic. So when game time comes, their body and mind act without hesitation. Trading is the same. The more you repeat your process, the less you have to think, the less chance you'll panic or deviate. That's why the best traders have simple, clear systems, because simple systems are easier to repeat perfectly. Complex systems create confusion and second-guessing. Discipline is the third pillar of mastery through boredom. Discipline means following your plan even when you don't feel like it, even when the market is slow, even when you're losing, even when everything in you wants to quit or chase a shiny new idea. Discipline feels boring because it's about doing what's hard and uncomfortable. It's about resisting impulses. It's about consistency over time. But without discipline, your trading is a house of cards. One emotional trade, one skipped stop loss, one impulsive position sizing decision, and everything falls apart. Discipline is what turns knowledge into results. It's what turns potential into performance. Routine is the final ingredient. Elite traders don't just wing it. They create routines that support their process. This includes pre-market preparation, journaling, reviewing past trades, setting goals, and managing emotions. A solid routine makes trading predictable and less stressful. It transforms a chaotic, emotional experience into a systematic, manageable process. Routines also anchor you during tough times. When the market is slow or the drawdown deep, your routine keeps you grounded. It reminds you that trading is a long game, and progress comes one step at a time. Now, let me share a truth that few traders accept. The real edge in trading is not finding the perfect system or predicting the market. It's having the patience, discipline, and stamina to stick to your process over thousands of trades. This means embracing boredom as your ally, not your enemy. It means accepting that success isn't a dramatic win, but the accumulation of small, boring, disciplined steps. And it means showing up every day and doing the work, even when nothing exciting happens. And that's how mastery is built. Here's the final thought. Trading is a marathon, not a sprint. The quick wins might feel great, but they don't create lasting success. It's the steady, boring grind that builds skill, confidence, and profits. So if you find yourself bored today, congratulations, you're on the right path. Because boredom means you're focused on process over outcome, on consistency over hype, on building skills over chasing thrills. And that mindset will carry you through the ups and downs of the market into the realm of mastery.